ongoing drop in the value of the US dollar is raising some pretty serious eyebrows and concerned about its future as a safe financial hideout. According to insights from the Finbold, the US dollar has seen a whopping sixfold decrease in the last 50 years. It's been a significant 86% drop since 1972. That means our $1 today has the purchasing power of 14 cents back in 1972. The dollar depreciation data is derived from the statistics supplied by the United States Department of Labor and calculated by the researchers at officialdata.org. The depreciation directly lowers the dollar's purchasing power. Thus, $1 in 1972 is worth $6.99 today. In other words, a dollar will buy you fewer items at the grocery store than it previously would. Inflation is currently hanging, they say, around 3.7%. Problem is that the computation of inflation has been adjusted several times through the years to account for changes in consumption patterns, the introduction of new products, and other economic factors. One significant change in the computation of inflation in the United States occurred in 1983, and another one in the 1990s. In 1983, the Bureau of Labor Statistics introduced the use of rental equivalents in the calculation of owner-occupied housing costs. Before this, the CPI calculated housing inflation based on house prices, which is what they should do. The change to rental equivalents was made because it believed to be better represent the consumption value of owner-occupied properties. During the 1990s, several changes were made in the methodology for computing inflation. Some of these included the introduction of a geometric mean formula that allowed for the substitution effect between items within the same category. CPI was also adjusted to account for changes in the quality of goods and services and the introduction of new products. Some say the changes in inflation calculation removes necessary biases, but I say you don't have to complicate things. Just look at the prices. Fuel was at $1.15 per gallon. Now it's $6 to $7 a gallon. No matter how much you slice and dice it, inflation is not as low as what the government claims it to be. The impacts of inflation are very clear. Incessant money printing by the government is diluting the dollar's strength, a situation made worse by pandemic repercussions and significant budget imbalances. Since 1972, the rate of inflation in the U.S. has risen, even as the economy has recovered from the depths of severe crises such as the 2008 recession and the effects of the ongoing COVID-19 pandemic. The U.S. dollar's value has fallen as a consequence of the government's continuous money printing, with major central banks pumping $9 trillion into the economy since the pandemic. The worries about the dwindling strength of the dollar are causing it to stir, leading to a shift towards assets like gold and newly emerging cryptocurrencies such as Bitcoin. These alternatives are becoming increasingly popular, maybe because of their perceived resilience against inflation with the dwindling strength of the dollar, with Bitcoin notably having an inflation rate 5 times less than the US dollar and continuing to decrease. However, with the Federal Reserve recently stepping in to tackle inflation by increasing interest rates, there's a need for careful investment planning, and it may result in a shift back to conventional saving routes. The constant shifts in economic landscapes and the ongoing devaluation of the dollar make it essential to rethink and diversify assets now. It's crucial for investors to thoughtfully explore alternative assets, stay informed about economic trends, and maintain a diverse portfolio to offset risks tied to a currency devaluation and ensure financial stability in these unpredictable times. Given the constant fluctuations and unpredictable financial climate, a need for strategic, mindful investment and diversification is becoming more and more crucial to navigate through the looming financial uncertainties and challenges that are on the horizon. Diversify, diversify, diversify. Talk to your financial advisor. When it comes to gold, physical gold, you can always come to us and we can help you. Noble Gold Investments has a team of US-based associates waiting on the phone to answer your questions. It's a no-pressure call. Call us at 877-646-5347. You don't want to talk to anyone right away, you can just go on our website, download our free investment guide at noblegoldinvestments.com.